when other people are willing to put themselves out there in the public eye, and that creates trust, it creates credibility, it creates a connection point.
Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hello and welcome back to Pillars of Wealth Creation. I'm your host, Todd Dexheimer. With me, excited to have Jeremy Dyer. Jeremy, how are you doing today?
Yeah, I'm doing well, Todd. Thanks for having me on the show.
Absolutely. Long overdue. Jeremy, man, he's been investing for quite some time. You started investing in early 2008, 2009, somewhere around there. Did some flips and then realized with the busy life, flipping maybe wasn't the right way to go. I'll let you dive into that story, but a little bit about Jeremy right now. He's the founder and managing partner, Starting Point Capital. Jeremy leads the company's investor relations, strategic partnerships, and serves as the director of marketing for the company. Starting Point has been extremely active over the last year plus. I'll let Jeremy fill us in. So Jeremy, with that said, give our listeners a bit more about your background. Let's talk about how you got into this, and then we'll dive in.
Yeah, sounds good. And appreciate that introduction. And you're right, it is a little bit long overdue. I really have you to blame, Todd, for me making that transition from active real estate investing into passive. So I'll kind of start with that. But yeah, I mean, if you go back 15 years, or so ago, my wife and I, we just frankly got bored a little bit and wanted to have a side hustle. And I've always had a knack for, real estate and certainly an interest in real estate. And my wife really likes interior design work. So, we watched an HGTV, episode of some show 15 years ago, and that sounded super sexy. So we decided to jump in, and we started buying and fixing and flipping houses. And, that was going really well. I learned a lot about the business. My dad just happened to be a general contractor, so he kind of managed, that side of the business. And my wife managed the interiors, and, I wrote the checks, right? What the challenge that we were having is when we got to 2015, the side hustle business, while it was growing and scaling, it was taking too much of our time. And what I mean by that is, I still lead a professional, day job. I'm still a W-2 earner. We also at that time ended up going from 2 to 4 kids, and their busy schedules, with their weekend activities and evening activities, was just putting us into a position where we really didn't have time to spend, swinging hammers on weekends and, designing interiors of homes and, certainly putting in offers on 50 houses before we get one, kind of a thing, right?
Yeah.
So we just got to the point in 2015, where we really kind of screamed mercy and decided to, for me to focus on my day job and grinding it out and crushing my W-2, while stepping away, from actively managing a real estate portfolio, so that we could really spend more time watching our kids grow up. That was really, at the end of the day, it was very much a relationship decision. And I had to make that decision in my life, to really focus on, spending time with my kids and my wife and building out my family, as opposed to, spending a lot of my discretionary time, on actively managing real estate.
You were probably able to make more money focusing on your W-2 than you were when you were flipping and doing your W-2 and trying to juggle the kids and the relationships and all that kind of stuff. Is that true, or am I wrong with that?
No, it's 100% true. Your listening audience may not know, but I'm a sales professional, right? And in a sales professional role, you're only as good as your last month's performance, right? So to your point, you're exactly right. I had to make that decision. I need to focus on my employer. I need to focus on, crushing my quota, month in and month out. And one of the great things about, kind of that transition into being in real estate on the passive side is the more I crushed my day job, the more disposable income I had to then deploy into, that next real estate investment.
So take me through. So you were flipping. You said, I can't keep doing this, right? This is eating into too much. I gotta focus on my W-2, focus on my family, do that thing. You started though, you didn't stop investing. You didn't say, I'm done with real estate, period. You said, I'm going to do this a different way. Let's talk about the way you went.
Yeah, the right out of the gates, I took that capital that we had actively deployed into real estate. Once we sold those properties, I deployed it straight into a debt equity fund. I was getting 8 to 12%, um, you know, distributions, on that income. And around that same time, then I had also learned about real estate syndications. Previous to that, I didn't really even understand the word syndication, other than I knew the Packers are a syndicated football team, but beyond that, I really didn't truly understand, what syndication meant. And certainly I had no idea, driving down the road, that the apartment on my left and on my right are actually owned by real estate syndicators who partner with limited partner investors to get involved into, diversifying into real estate. So it was really at that time that I learned what syndication meant. And I will be honest with you, I took the shotgun approach in that first, investment that I made. I just knew and I liked the sponsor enough to hold my breath, plug my nose, send that wire transfer in and kind of hope for the best. Right. And thankfully, that investment turned out well. I just wish I had doubled down on the strategy earlier, quite frankly. I waited several years for, the theory to kind of prove itself, before I started redeploying additional capital, as a passive limited partner investor.
Yeah, I think that's pretty natural. You put that first one in and you go, okay, does this work? And a lot of, and that's active or passive. You're like, okay, well, does this work? How is a debt equity fund? You said debt equity fund and now syndication. How is a debt equity fund different from a syndication?
Yeah, I mean, the debt equity fund really provides, consistent, regular cash flow. Those funds end up going into, other types of syndication projects for sponsors that are looking for some additional, capital, right? To acquire assets, some of which are syndicated opportunities and some of which might be joint venture opportunities. But really the debt equity fund provided that regular, consistent, mailbox money, cash flow, but there's no equity upside, right?
Yep.
And there's no tax depreciation benefits either, right? And so I'm a big fan from an investor perspective to be diversified. I like to invest into, opportunities that are a little bit lower risk, right? Like a debt equity fund as an example with no equity upside. And then I like to balance that with an approach where I'm seeking both, cash flow, as well as where there's an equity upside, element at the end, when that deal goes full cycle.
Yeah, love that. I think that's smart, especially if you've got some funds to play with and to be able to then balance your portfolio out nicely. I think it's funny you mentioned that you especially if you're not in this world, you don't even realize it. Like most of the apartment buildings that you drive by on a daily basis are owned by a private equity group, a group that, they've got somebody that's maybe on paper looks like the owner, but they've got a bunch of money, which is people backing that deal. So it's a syndication or some sort of form like of a syndication type group. Most of the vast majority of them aren't just owned by you or me. It's completely, it's owned by a big group of people. It's so funny to think. I mean, that's how I thought when it's just by some rich people, right? Some rich people own this thing.
Yeah. I mean, you assume, right, it's going to be owned by, like a private equity
Or a
firm.
big private equity firm. Yeah.
Yeah, a
Yeah.
BlackRock, a Vanguard, a State Street, something like that. But little do you realize, wow, there's a lot of these apartment buildings across the country, that are owned by, people like you and me, right?
Yep.
And I'm an owner of a lot of them, but it's just as a completely passive limited partner. I don't have voting rights. I don't make decisions on,
Yep.
how the, lead sponsor is managing, that asset. And I'm just kind of along for the ride.
Yeah. So you started With this debt equity, then you went into syndications and you obviously expanded from there. And now I guess take me through that expansion and then now what you're doing right now with Starting Point Capital is similar, but with a kind of an extra little I don't know, bonus on top of it, I guess.
Yeah, no, great question. So what I haven't explained yet is when I got to 2019, I doubled and tripled down on the strategy as a limited partner passive investor. And so now, if you fast forward from 2019 until today, my wife and I are limited partner investors in 27 investment properties or projects. Okay. 80% of them are in the multifamily space. 20% of them are in other asset classes, whether it be, self-storage, retail, flex office, assisted living, right? I've also chosen to diversify into different markets. So on the multifamily side, most of those properties are going to be located in Tennessee, Ohio, Texas, the Carolinas, Arizona. Okay. So then now if you go back just 18 months ago, okay, I was seeing how impactful my passive real estate investments were on replacing the dependence on the W2. Okay. And while it takes some time for those theories or that plan to prove out itself, right? Initially your distributions might start small, but they start to kind of grow over time. Really the main upside to the investor is when these deals start to go full cycle, or there's a capital event, for example, like a cash out refinance. That's really when the investor starts to see some of these returns. So I was starting to see some of those returns on some of the early investments that I had made. And I've now gotten to the point in which, I'm fairly confident that within the next, call it 2 to 5 years, somewhere in there, my passive real estate investments that I've made over the last several years, that income is going to completely replace my hard earned W 2 income. So I've personally seen how impactful it can be on an investor. Now, it obviously takes money to make money in this business,
Right.
which is why I'm dead set on encouraging people to keep crushing your day job. Okay, keep maxing out your earnings, max out your W-2s. Find a way to deploy capital, into multiple real estate, opportunities over time. Because once some of those deals come full cycle, they start to compound on one another, and they're tax advantaged, right? Neither you nor I are CPAs or tax professionals, but we can see, how the tax benefit side allow you to really minimize the tax consequences, some of the gains that you're making. So now 18 months ago, I was given the opportunity by someone by the name of Todd Dexheimer. I don't know if you've heard his name before, but Todd gave me the opportunity to help partner along with him on really providing references to investors that are looking to maybe deploy capital for the first time in a real estate syndication. I was hopefully a good reference, for Todd at that time, right? Because I, was able to kind of speak specifically to the impacts and kind of the ins and the outs, from a real limited partner, passive investor perspective. But what I also learned at that time is that I really enjoy this. Okay. I really enjoy having conversations with people that are just like me, higher net worth individuals, that are, choosing to diversify outside of Wall Street and into Main Street. Maybe they're done with kind of that roller coaster emotional, roller coaster of the markets going up and the markets going down. They want to create passive income for themselves. So at that time, I made the decision to start Starting Point Capital. My business is largely an education platform that gives investors the opportunity to partner with us into future investments. So a big part of Starting Point Capital is really educating investors that are not familiar with, just like I wasn't, they weren't familiar with investing passively into a real estate syndication. And that's really the genesis of our company, is to continue to educate people like you and me on the strategy.
Yeah, and so Starting Point, what you're doing is because creating a fund, right? Creating a investment vehicle to then invest in these passive deals um, with you, alongside of you. You're still investing in all of these opportunities. Your partners, you guys are investing in these deals, and um, people that you've educated, people that you know are saying, "Hey, yeah, I'd like to invest alongside of you." That's correct, right?
Yeah, totally correct. I mean, at the end of the day, like my partners and myself, we're going to invest in these deals regardless if anybody else chooses to partner alongside of us. But the way that we've really created and structured it is through what we call an SPV, a special purpose vehicle, flex fund. And we can dive into some of those details if you like. But one of the one of the main leverage points that we have with the sponsor is our fund then can produce a preferred return, or I should say a better projected return to investors that partner alongside us into the investment.
Hmm.
So we basically allow our investors to gain access to higher projected returns that would typically be reserved for investors that are coming in with large checks, say 50,000 or $1 million investors, right? We're giving our investors similar return profiles that those types of investors would get, while allowing them to come into our investment opportunities at a lower amount, say 50,000, for example.
Let me just make sure listeners understand how this works, right? So when you're a general partner and you're raising money, you oftentimes, not always, oftentimes you'll have a couple different share classes. And one of them, your traditional share classes for that investor that can come in for the minimum, 50,000, maybe it's even 25,000, whatever it is, they can come in for that minimum and they can invest. And maybe it's a 70-30 split with the equity. Maybe it's a 7% preferred return. Okay. Then you've got a group like what Jeremy was just talking about, where if an investor comes in at $1 million or more, maybe it's 5 million, maybe whatever. There's a floor though. Say you come in at this amount, we'll give you, instead of a 70-30 split, maybe we're giving you an 80-20 or 90-10 or something like that. Maybe instead of a 7 preferred return, we're giving you an 8, or maybe it's even a 9 or something like that. So we're giving you better benefits if you come in with more money. What you're telling us is that that's what you're doing, is if you guys as a group come in with $1 million or more, or whatever that benchmark is, that you're getting that better split. And as a group, then you're able to benefit from that. Is that
Yeah, you're spot on. And it really comes down to obviously leverage, right? You know, we have the leverage because we know when a sponsor comes to us with an opportunity, you know, after we've done our own due diligence and we're willing to put our own money into that deal, you know, as partners of Starting Point Capital, we're able to leverage with the sponsor a larger check, right? So there's a cost of capital, you know, to the sponsor, and the sponsor is willing to give us preferred return economics, which we then, you know, really push a lot of those preferred return economics off onto our investors, which really gives them the opportunity to earn more than what they would if they went retail direct into the deal. And, you know, as most of your listening audience knows, you know, most of the opportunities that are out there, you know, are Regulation D 506B offerings, which means that you have to have a relationship, you know, with
right?
the investor in order for them to get into the deal. So sponsors certainly like Starting Point Capital because we're able to maintain, you know, an SEC compliant relationship with our investors,
Right.
where the sponsor doesn't have to do that directly.
Yeah, and so they're getting a couple benefits from you. First of all, they're getting a deal brought to them that they maybe wouldn't otherwise even find, right? They're also getting a deal brought to them that has been pre-vetted by you for whatever that might be worth, by the way. As an investor, you want to make sure that you vet your own deals. Don't if you're listening to this and you're like, yeah, I like what Jeremy says, I'm just going to listen, I'm just going to invest in everything he invests in. Don't be stupid, right? I think Jeremy's a smart guy, but you want to make sure that you check too, but at least you've got somebody else's eyes that have been on it, that has approved it. And you go, okay, somebody else likes this deal. I trust this guy. Now I get to take my own look at it. So you've got a pre-vetted deal. And then the last thing is you potentially have some better returns than if you just put your money directly into that deal.
Yeah, you're exactly right. And that's one of the things we encourage all of our investors to do is listen, before you invest into one of our deals, invest in yourself first. Okay.
Mm,
Well, what does that mean? Learn about
right,
the due diligence process, learn about the underwriting process,
right.
learn about all the assumptions the sponsor uses to come up with their internal rate of return and their equity multiple. Ask questions, right? All of that is incredibly important, for really all investors, both those that are experienced and non-experienced, to really ask those questions. And quite frankly, if you don't have an opportunity that comes with a sponsor that's not encouraging you to invest in your own education, then you might want to think twice about investing with them.
Yeah. Yeah, I couldn't agree more. One thing that we make sure we do is anybody that's new, we're going to give them kind of a new investor packet. I know you do the same thing. Yours probably looks different than mine, but you're telling these are the things you want your investors to look at and learn about. And we've got blogs, we've got all kinds of resources that we send them, and we also have our previous deals that they can take a look at. I think that's really important to look at previous deals that have happened. You can't invest in those deals, are already done, but at least you can see what's being offered and you can look and you can start to get to know the numbers. That way, when that next deal does come to you, it's not just I don't even know what this thing is even. So you want to, for sure, you want to educate yourself. One thing that I think is awesome that you're doing, um, is really bringing that to the forefront, right? Making that's really important to you, is making sure that they're educated. And I think that's really, it helps your investors a lot.
No, absolutely.
So what what does it take, Jeremy, to for those who want to raise money or are wondering what does it take to raise millions of dollars? Because not everybody can do it. You and I know people that have wanted to raise money or want to raise money and struggle with it or can't do it at all. And then there's others that it seems like it's just so easy. Like, is there a magic formula or a secret sauce?
Great question, and I get that question a lot. For your listening audience that doesn't know me, I not putting a feather in my cap, but what I would say is I kind of feel like I could be the capital raising rookie of the year because I've really only been at this for a year or so. Okay.
Yep.
We've been able to raise literally tens of millions of dollars from hundreds of investors now, we can say, okay, in a year's time period. And what
Yeah,
I would
which is
tell
remarkable, by the way. Like that most people, if you ask them what they raised in their first year, it's under 2 million. But well, most people, it's probably under a million, and a lot of people, it's under 500,000.
Yeah, no, and I know that, and I hear from those individuals on an almost daily basis because they want to know the question that you just asked me, and what's the secret sauce? Okay. The secret sauce for me specifically has been all about my reputation. Okay. A reputation that I didn't create in days, months, but literally not just years, but decades. Okay.
Mhm.
So it's been relatively, I would say, easier for me to raise capital from people that already have known me, have liked me, and have trusted me for decades. So, and a lot of that comes down to me continually trying to become a better version of myself. So I've really always taken it upon myself in my professional job and in my personal life to really continually level up my game, right? Continually, work to expand my network, continue to find ways to provide value to others, right? To continue to crush my professional day job. So there's all kinds of things that go into that, right? The other side of it is really the best time to raise capital in this game is when you don't need it, right? So I find ways to continue to use a drip marketing type of a strategy to continue to stay relevant, to continue to stay in front of people that are part of my personal and professional network, so that in the future, if I provide value in the future, when I have an opportunity available, those
Mhm.
investors or those individuals are then more likely to partner with me. The other side of that, which I think is a bit of a challenge for a lot of folks that are looking to raise capital, is they're not willing to put themselves out there. Okay. when I mean, but what I mean, but when I say that is putting yourself out there on social channels, whether it be, LinkedIn or Instagram or whatever your, social media flavor channel is, right? There's unfortunately in this space, not a lot of people that want to put themselves out there. Okay.
Yep.
Record a video of them talking about something that provides value to their audience, taking a picture of themselves and providing a write up of something, a lesson learned, this week or this month. Right. And I think that people really resonate when other people are willing to put themselves out there in the public eye, and that creates trust. It creates credibility. It creates a connection point, on a human level with the other individual. And when you do that with people, they're more willing to want to work with you. And really, quite frankly, they want to learn more about what you're up to, right? And when they learn about what you're up to, that gives you it gives you that opportunity then to further educate them, and then ultimately give them that opportunity to partner with you on a future investment opportunity.
What's your favorite social platform?
LinkedIn is the playground.
Yeah. Yeah. I think LinkedIn is way underutilized. And I think it's just starting to become thought of by more and more people. But LinkedIn is so underutilized. Obviously, podcasts are great as well. Um, I think one thing that maybe you didn't say, or maybe you said indirectly, but personality plays a big part into it as well. I think people need to be real with themselves. Do you have a personality that allows you to raise capital? And just be honest with yourself. Like, Jeremy, you're a sales guy and you're a successful sales guy because you have a personality that allows you to sell. And now you're not a slick car sales guy. You're a sales guy that you're easy to talk to. People trust you very quickly because you're honest and because that's how you portray yourself. It's just how you talk. Um, and you know how to do all the little things too as a salesperson, but you've got the personality to be successful at it. There's other people that just don't. And be honest with yourself. If you're that person, it's okay because there's many other things you can do, by the way, other than raising a bunch of capital. Would you agree with me, or am I off base on that?
No, I think you're spot on, Todd. And I think, one of the big things that allow me to kind of be a magnet in this business where people just want to, learn more about what I'm up to, and they're willing to, send $50,000, $100,000 checks, right? Time and time again. It really comes down to this, idea or concept of genuineness, right?
Yeah.
Like, I'm just genuine, right?
Yeah.
I will be very transparent with an investor. This is not a get rich quick scheme at all. Here's
Right.
here's the skeletons that could potentially reveal themselves in the closet, right?
Hmm.
This is how, these types of investments from a risk adjusted perspective, work, right? You're not throwing your money at Apple stock or Facebook stock, not knowing what's going to happen, but there's a local team that's actually managing the value add business plan that I have a
Right.
direct relationship with. I know I can trust them. I've, invested, time and time again, my own money with them, right? But it all comes down to their ability to execute on the business plan, and you trusting that they're going to be able to do that, right? So I would say that, a lot of it comes down to genuineness. Another side of it is I think a lot of folks that are in the capital raising space struggle with imposter syndrome.
Hmm.
Okay. They that imposter syndrome of just not feeling incredibly comfortable with what they're doing prevents them from doing more of it, right?
Hmm.
And what I've learned when it comes to imposter syndrome, that's kind of the anecdote, is the rinse and repeat, the continuing to put in more reps, continue to do the thing over and over and over and over
Right.
again. And the more you do it, the more you realize I'm not an imposter at all here. Okay. I am literally providing real value and real opportunities to real individuals that can make a significant impact on that person's financial well-being now and into the future. And when you get to that point where you're confident in your approach and your understanding, and you put in the reps over and over and over again, you can rest assured that I'm not an imposter at all in this game. I am literally, providing, value to my audience and to the people that I connect with in a meaningful way.
By the way, you go out there and you say, "Hey, I'm gonna invest in this deal. I really like it, and I'm gonna tell all my connections that I've kind of built these relationships with about this deal." And you bring in two people only. You fall flat on your face, or you think you fell flat on your face, and these two people come in, and that's $100,000, and so now all you got is your money. Maybe you're going to put in $100,000 in this $100,000. You thought you fell flat on your face, but what I'll tell you is you've raised more money than 90, probably 5% or more of the people out there that have ever raised money. So just by raising $100,000, you did better than most people. And most people will be impressed that you raised $100,000. You thought you fell flat on your face, but you've done something that most people have never done before. That's the imposter syndrome that Jeremy's talking about. Put in the reps. Next time, raise $200,000. Yeah, did you do what you wanted? No. Next time, raise $500,000, then $1 million, and it starts to snowball from there.
Yeah, no, absolutely. And you're exactly right. I mean, you might think you failed in that pursuit, but the reality is, look at all the lessons you've learned, right? And going through that exercise and those conversations that you're having with investors is only going to get stronger the more you do it, right? The more you have those interactions and you have those at bats, the more likelihood you're going to be in a better position, come the seventh, eighth, ninth inning to make an impact, for your team.
Yep. I talk to a lot of people, Jeremy, that are like, they're kind of embarrassed. You ask them, have you invested in real estate before? Oh, nothing much. I've owned a duplex, or I invested in another syndication, only $50,000 or only $25,000. And they kind of are embarrassed that they haven't done more. And it's like, wait a second now, you have done literally 95 or more than what 95% of the population ever will do. So be proud of that duplex. You might not think it's a lot, but most people would be like, oh my gosh, it's amazing. Right. So be proud of that.
Yeah, no, you're exactly right. And that's one of the things that I think helps also make it easier for me to have conversations with potential new investors is because I've done it, right?
Yep.
I've been on the active side of real estate ownership, which a lot of investors want to get into it actively. And then I kind of, explain what that's going to probably look like, right? They're like, maybe I don't want to do that, right? But on the other side of it, I'm in 27 deals as a limited partner investor, right? I started investing passively, back in 2015, right? Which
Right.
is almost 9 years ago now. So I have a story that I can tell of real impact and how it's really, truly, impacted our own, financial journey.
Yeah, that's powerful right there. And even if you don't have 27 deals that you've invested in and don't have that big track record, if you start and you can point to that story, that's huge. Um, Everybody loves real estate. I say that all the time. Everybody wants to be a real estate investor. Well, why be passive versus active? Because in active, I get to control the deal, right? I should be able to make more money, all this kind of stuff. Why passive versus active? And by active, by the way, just so our listeners know, by passive, I mean putting your money in a syndication, putting your money into a debt equity fund, something like that. By active, I mean buying your own duplex, buying your own sixplex, even if you have a property manager, I still call that active.
Yeah, I mean, obviously, as you know, and your listening audience, probably knows that it really comes down to your own personal goals, your own personal bandwidth, right?
Yeah.
I kind of joke with people now that if you want to get into active real estate ownership, that's fine. But just so you know, it's a young man's game. Okay. What do I mean by that? Okay. If you want to have a family someday and you want to see your kids, grow up and you want to have a relationship with your wife and you want to do all the things that you want to do, personally speaking, then it's probably better if you become a passive investor versus actively managing a real estate portfolio or fixing and flipping houses like I do. Now,
Yeah.
everybody's got so much time in a day, right? And so you need to really figure out, how much time would you have available to allocate towards actively owning real estate. And then let's take a look at the last 12 months of your life. And at what point in the last 12 months of your life would you have been in a scenario or a situation in which you wouldn't have been able to actively manage that real estate portfolio?
That's
It's
a
one,
great way of thinking it, by the way. I
yeah,
love that approach.
I mean, think about it. Like if you got sick in the last year, okay, and a tenant called you up and said my toilet's clogged, okay, you might be barfing over your own toilet, but now you got to go clean up somebody else's, right? You know, that kind of thing. So I think about that, but I also it's not just the time, okay,
Yeah.
because you can learn a lot of lessons through active real estate ownership.
Yep.
And quite frankly, I encourage people sometimes to consider doing that, right? In addition to passively investing in real estate, because they're going to really learn the business. Okay. The other side of that is opportunity cost. Okay. What's your time worth? Okay. And what would be the opportunity cost of instead of putting $50,000 into grandma's house down the road, fixing and flipping and renting it out? What would be the opportunity cost of instead putting that $50,000 into a passive real estate investment? You know, what would the returns and the risk, you know, look like? So you really have to weigh that out as an investor to determine what's right for you. But in full disclosure, my son's 17 years old. Okay. He's going to be going to college in a couple of years. He's not going to rent. Okay. And he's not living at home either. Okay.
Yeah.
What's he going to do is going to house hack, right?
Yep.
We're going to find a house for him to buy and rent out a couple of rooms in there and get his buddies to pay his mortgage, right? So but it's a young man's game.
But he's young, he's got time, and he's going to learn a ton of skills. By the way, he's going to learn what he likes and doesn't like about it. That's a super valuable lesson. I agree. There's never a either or, right? It's what fits you, what fits your lifestyle. If you're going to be active, understand it's a business and treat it like a business. If you're going to be passive, you don't have the control, but you have the time.
Right.
So love it. You've done 27 deals. You've probably learned a thing or two that our listeners just don't know. What are your top, maybe 3 to 5 lessons you've learned that you can pass down to our listeners?
Yeah, I don't know if I can come up with 3 to 5, but let me come up with a couple of them that I think are really important. Okay. And that is don't chase after the IRR. Okay. I would
Love that.
much rather, now that I know what I know now, I would much rather really truly spend time, vetting out the opportunity, challenging the assumptions,
Yep.
okay, that the sponsor made, during their due diligence and in their underwriting. Okay. There are some very simple assumptions that you can challenge as a limited partner investor as you pour through the financials and the underwriting. Okay. Simple things like expected, exit cap rate, as an example, wage growth in that market, job growth, job diversification, loss to lease, which is oftentimes brought up a lot, in an investor presentation, really challenge those competitive assets in that market that maybe are already repositioned or their new product. Will the sponsor successfully be able to burn off that loss to lease, during that value add business plan or not, right? The other lesson that I would say, which I'm thankful that we deployed right away, and that is really a diversification. Okay. I regularly have investors that will come to me and they'll say, hey, Jeremy, I've got, $500,000 sitting in an old IRA from my old employer, and I'm going to self-direct that into your next investment opportunity. And I say, while I would be really appreciative of you putting $500,000 into my next deal, let's pump the brakes. Maybe let's consider doing, 5 different deals at 100K each, or 10 deals at 50K each, right? Let's put that money in multiple different markets for diversification reasons, maybe even different asset classes.
Yeah, I had an interview with a guy. This was several years ago, and he had several multifamily investments. I think it was like 12, and 2 or 3 of them went completely sideways and lost all of his investors' money on those. I think it was 2 deals. And he said, what really sucks is those investors lost all their money. But he said the investors that invested in all 12 of my deals, they weren't happy, right? But it didn't bother them that much because they lost the 50K on that one, but on all the other ones, they doubled their money.
Yeah. Yeah.
So
Yeah.
if you've got the resources, I agree to diversify. And I say the same thing. I get people that are really excited about putting money into, they want to put three, four, $500,000 in a deal. I'm like, wait a second, let's spread that out. It makes a lot more sense.
Yeah. I mean, your financial advisor is going to tell you to diversify. Your financial advisor is going to tell you to, invest at all different, stages of the cycle, right?
Yep.
For dollar cost averaging, right? You can use those same strategies when it comes to real estate investing. And the
100%.
reality is none of us have a crystal ball. Okay. So we don't know what exit cap rates are going to be in 5 years. We don't know. Okay. We have
Right.
projections. We can make some assumptions, right? That kind of thing. But at the end of the day, we don't know. But I am very confident in taking the strategy of dollar cost averaging, diversifying, income into multiple investment opportunities. I'm also a big fan of making investments at all different stages of the economic cycle.
Yep.
Okay. The reality is, and you know this full well, back in 2016, 17, 18, 19, everybody thought a recession was months away,
Oh yeah.
right? Well, if you chose not to invest in real estate in 16 through 19, you missed out on a huge run up, right?
Yep.
And so that's why I'm a big fan of, not putting all my eggs in one basket, diversifying those investments over time. And the beauty of investments that I made 5 years ago, once they start to eventually come full cycle, right? Not only am I deploying that original capital into the next deal, but I'm also deploying those profits as well. So you
Right.
can definitely see how that compounding effect can make a huge impact.
Yeah. Love that. Love that. Jeremy, I got a couple last questions. I want to pivot here. A couple last questions before we wrap up. What's a favorite book you can recommend to our listeners?
Yeah, I've got a couple of them. I really like The Psychology of Money by
That's a
Morgan
great
Housel.
book.
Yeah, I'm a huge fan of that book. Both my 15 and 17-year-olds have read that book. I'm a huge fan of the Hands Off Investor book by Brian Burke. In fact, I oftentimes will challenge potential new investors to read that book before they decide to invest, with us into a future opportunity, because, that book is jam packed with, a dozen hours of what are real estate syndications, right? What are sponsors, what are LPs, GPs, IRRs, there's lots of acronyms that we can throw at investors, right?
Yep.
That book just does a great thorough job, of really explaining, all the intricacies of real estate syndications and investing, passively. And then I would say maybe the last one, I know this kind of gets thrown out probably on your show a lot as it does mine, the Purple Book, right? The Rich Dad, Poor Dad book. Just this Christmas, I bought my boys Cash Flow, which is a board game by Robert Kiyosaki. And I think his wife was involved in the
Yep.
creation of that board game. But my kids can't stop playing that game. Like every
We're
night,
we're coming over and we're gonna have a board game night with the kids.
so many lessons learned in that book, Todd. I wish I had the opportunity to play that board game like 20 years ago.
Yeah,
I
right.
think things would have looked a little bit different, but so glad my kids have that opportunity.
Yeah, that's great. What are your Jeremy? What are your three pillars of wealth creation?
Yeah, I would say relationships matter.
Mhm.
That's got to be number one for me. And it's not just relationships with, people that are outside your family, but get your own house in order. I'm a really big fan of investing in relationships, whether it be with my wife, with my kids, with my neighbors, with others. Relationships are very important to me. One of the pillars that we brought up before, there's obviously the diversification, side to investing. I'll never tell somebody to get out of Wall Street, but if you're not invested into real estate outside of the home that you live in, you probably should consider it, because that investing strategy over time has proven to be, a better investment than even any one that you would make within Wall Street. And then, I'd say the last pillar is really, my faith. That's really my kind of my guiding compass. I'm a man of faith, and so that conducts itself in how I relate with other people, right? In terms of the decisions that I make, knowing that that my faith and relationship in God is really my compass and life in general.
Awesome. Love it. What did we miss? Anything?
Oh, Todd, you and I both know. So your listening audience doesn't know this about you and I, but Todd and I get together every so often, and we could literally talk for days without
Yeah.
stopping.
Like 5 or 6 episodes we'd probably have to chunk this up into, but that's okay. Jeremy, how can our listeners get in touch with you, learn more about what you got going on?
Yeah, thank you for asking. So I'm fairly active on LinkedIn. You can find me there under Jeremy Dyer. I also host a podcast that produces 2 episodes per week called The Freedom Point. And then thirdly, you're welcome to check out our website at startingpointcapital.com. Again, startingpointcapital.com.
Awesome. We'll throw that in the show notes. Jeremy, really appreciate it, man. This has been fun. And like you said, we talk often, but it's always fun to have a formal interview like this, and long overdue, but it was a good time. So appreciate it. Appreciate all the value, tons of value here, by the way, listeners. So if you miss something, just go back, rewind it, but take a couple notes and use it. Take what Jeremy said and apply it to your life.
Todd, thanks for having me on the show.
Hey, thanks so much for listening. I appreciate you being a loyal listener. Say, I would love to have you go on to our Facebook page and subscribe. Give us a thumbs up. Go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. But your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out, and we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.